Ever been in a tug-of-war? Imagine that, but in the stock market. That's what happens when a doji pattern forms. Picture a battlefield where each side is struggling for dominance. The buyers, optimistic, confident, pulling the market upwards. The sellers, cautious, skeptical, dragging the market downwards. It's a constant struggle, a relentless tug-of-war, and the result, my friends, is the creation of the doji pattern. The doji pattern is a fascinating phenomenon in the world of stock trading. It's like the market's own version of a dramatic cliffhanger. You see, the doji is a candlestick pattern that signals indecision, a stalemate if you will. It's when the opening and closing prices of a stock are almost identical, resulting in a very small body. But don't let that tiny body fool you. It casts a long shadow both above and below, like a tall and slender exclamation mark standing in the midst of the market melee. Now, this pattern occurs when the forces of supply and demand are equally balanced. The buyers and sellers are in an intense face-off, each side trying to push the market in their direction. But at the end of the trading period, neither side manages to gain the upper hand. The result? A standstill in the market, where the opening and closing prices are virtually the same. It's like a suspenseful movie scene, where the hero and villain are locked in a fierce duel, their swords clashing, sparks flying, but neither one is able to overpower the other. The market, like the audience, is left in anticipation, waiting for the next move. So the next time you spot a doji pattern in the stock market, remember, it's not just a simple line on a chart. It's a testament to the market's struggle, a symbol of its indecision, a visual representation of a tug-of-war between buyers and sellers. The doji pattern is the market's way of saying, well, that was a tough battle, but no one won today. It's the market's suspenseful pause, a still moment before the next big move. And as traders, we're all waiting to see which side will pull harder next time. Think of the doji pattern as a secret message from the market. Except it's not that secret, and it's not that hard to decode. In fact, it's like a telegram from the world of stocks, a signal of a potential shift in the market tide. It's like your own personal insider tip, dressed in a suit of candlestick elegance. Now, let's dive into the anatomy of this pattern. A doji has two main components, a small body and a long shadow. The body, as petite as it is, represents the opening and closing prices of a trading period. When these prices are nearly equal, the body becomes a thin line, a horizontal thread of indecision. On the other hand, the long shadow, stretching out like the arms of a starfish, embodies the highest and lowest prices during the trading period. These shadows are the battleground of the bulls and bears, the buyers and sellers. Their length is a testament to the tug-of-war between the two forces, a war that ended in a stalemate for that trading period. So what does this all mean? Well, when you see a doji, it's the market's way of saying we're at a crossroads. It's a sign of indecision, a pause in the trend, a moment of market hesitation. It's the financial equivalent of a shrug, a maybe, a let's wait and see. But don't let its nonchalant demeanor fool you. This pattern is powerful. It can signal a potential reversal in the market trend. It's like a yellow traffic light, urging you to slow down and reassess before you make your next move. Remember though, the doji is not a standalone signal. It's one piece of the puzzle, a chapter in a book, a note in a symphony. It's best used in conjunction with other indicators for a more accurate reading of the market's narrative. So when you see a doji, it's like the market whispering, hey, we're not sure where we're going from here. And as traders, it's our job to listen and decipher that whisper into a strategy that works for us. Just like people, doji patterns come in all shapes and sizes. They're the chameleons of the candlestick world, reflecting the market's mood swings with their versatile forms. Let's dive into the four main types of doji patterns: neutral, long-legged, dragonfly, and gravestone. The neutral doji, sometimes known as the perfect doji, is the poster child for market indecision. It's got a tiny body, smack dab in the middle of its upper and lower shadows. This tells us that the bulls and the bears are locked in a tug-of-war, with neither side gaining the upper hand. It's like watching a thrilling tennis match where the ball keeps bouncing back and forth over the net. Next up, we have the long-legged doji. As its name suggests, this doji has long shadows, indicating that the market went through a roller coaster ride during the trading session. It's like a seesaw that sways wildly before settling at an equilibrium. This shows us that while the market was volatile, no clear winner emerged by the end of the session. The dragonfly doji, on the other hand, is like a weightlifter who only works out one arm. Its upper shadow is almost non-existent, while its lower shadow is long and strong. This suggests that the bears tried to pull the market down, but the bulls flexed their muscles and pushed prices back up. It's a sign that the buyers may be gaining strength. Last but not least, we have the gravestone doji. It's the mirror image of the dragonfly, with a long upper shadow and no lower shadow. This tells us that the bulls charge forward only to be pushed back by the bears. It's a sign that sellers are starting to flex their muscles. In the end, each doji tells its own story, painting a picture of a market in flux. They're like the weather vane of the trading world, spinning this way and that as the winds of market sentiment shift. Remember, a doji is not just a doji, it's a tale of the market's indecision told in 4 different ways. Now that you know what a doji is, let's see it in action. Imagine you're a knight entering the battlefield. Your sword is your knowledge, and your shield is the doji pattern. You're standing in the midst of a fierce battle between the bullish buyers and the bearish sellers. Suddenly you spot a doji, a warrior who doesn't take sides, but rather signals a pause in the battle, a moment of indecision. Picture the stock market as a tumultuous sea. The price waves are crashing, and amidst the chaos, a doji appears, like a lighthouse, guiding you through the storm. In real-life trading scenarios, spotting a doji can be a game changer. It's like a secret code, a signal that the tides may be about to turn. Take, for instance, a stock that's been on a bullish run, the price rising higher and higher. The buyers are in control, they're winning the battle. But then a doji appears. This could be a sign that the buyers are losing steam, their grip on the market is loosening. It's a signal to traders that it might be time to take a defensive stance, to prepare for the possibility of a market downturn. On the flip side, in a bearish market, where the price is spiraling downwards, a doji might indicate that the sellers are running out of ammo, the bears are getting tired, and the bulls might be ready to charge. Traders who spot this doji might start to consider buying, anticipating a potential market upswing. But remember, a doji is not a crystal ball. It doesn't predict the future. It simply reflects the current state of the battlefield. It's a tool, a piece of the puzzle, helping traders to interpret the market's mood and make informed decisions. When you spot a doji, you're not just seeing a candlestick pattern, you're getting a glimpse into the soul of the market. And just like understanding a person's soul requires patience and insight, interpreting a doji requires practice and wisdom. So, let's continue our journey and delve deeper into the strategy behind this fascinating pattern. Alright, you've decoded the doji, but how do you use it to your advantage? Here's where the rubber meets the road, my friends. Let's talk strategy. The doji, that tiny little candlestick of indecision, can actually be your secret weapon in predicting future market movements. Why? Because it's a clear signal that the market is at a crossroads, that the bulls and the bears are in a tug-of-war, and that change could be on the horizon. So, how do you seize this moment of indecision? First, remember that the doji is not a green light to trade. It's more like a yellow light, a signal to slow down, observe, and prepare. A doji indicates a potential reversal in the market, but it doesn't guarantee it. Secondly, context is king. A doji at the peak of an uptrend could suggest that the bulls are losing steam and a bearish reversal might be in the cards. Conversely, a doji at the bottom of a downtrend could mean the bears are running out of puff and the bulls might take over. But remember, these are not certainties, they're possibilities. Lastly, a doji is most potent when followed by a confirmation candle. That's a candlestick that moves in the direction of the potential reversal. It's like a second opinion from the market, giving you a bit more confidence to make your move. With the doji as your guide, you can navigate the market's tumultuous seas with confidence. So there you have it, the doji pattern, your secret weapon in the stock market. This humble candlestick, the battlefield of buyer and seller indecision, holds the key to predicting market trends. Remember, the various types of doji, from the long-legged to the dragonfly, each have their unique story to tell. Armed with this strategy, you're one step closer to trading mastery. Don't forget to subscribe to our channel for more insider tips and strategies. Remember, the market speaks to those who listen, so keep your eyes peeled for the doji.